Hello, this is Cushman Wakefield IQ interview, and today we're going to talk about future of office market, future of workplace, and the consequences of pandemic on the office market. My name is Denis Sokolov. I'm running research team in Moscow, Russia, and today I have with me people from different parts of Europe. It's first of all, it's Greg Mansell from London.
Hi, everyone.
It's Ramiro Rodriguez from Madrid.
Hello, Denis. Thank you for having me.
And Annika Edström from Stockholm. Annika, hello.
Hello.
So let's just kick off. Maybe you can describe what is happening on your market currently. What are the Q3 results on office market, and what is the current situation with pandemic? And I also want you to emphasize to dive a little bit deeper in the regulation, because everything depends on the regulation. Everything depends on approach that our government is taking against pandemic. And Annika, I would like to start with you.
Thank you. Yes, looking at the Q3 figures, we've had a very, very liquid transaction market during Q1 and Q2 in Sweden. Q1 was actually a record quarter, looking back. I would say maybe that the market has been a little bit exhausted coming into Q3. Maybe not new discussions started during the summer and the spring, so we've had a bit of a lower transaction volume during Q3. But we're very, very, very happy with having international investors back. It's almost 30% of the total volume is international investors, from having almost no international investors during Q2. So that looks very, very good. And looking at rents, we are quite stable coming out of Q3 at the moment, and also with the yields, with the very, very high investor interest in the market, we are looking at the yields being stable ahead, also for office properties. In other segments, we've actually seen compressed yields. So it looks a bit uncertain on the office market, but still quite good. And regulations and the situation in Sweden at the moment, we also have more contaminations now after the summer, but it's, knock on wood, from very low levels still. We had real big problems with the spread during the spring. As many of you remember, it was not very, we were not very happy from a Swedish perspective, being known for that in the world. But now it looks a bit better, and knock on wood, we don't have a spread among the elderly population at the moment. But Sweden has had quite a different approach to many other countries around the world. We did not have a lockdown during the spring. However, the government recommended Swedes to work from home and to avoid public transport. And the behavior impact of that was basically a lockdown during April. And this has had a very significant impact, especially on retail and food and beverages and hotels, and especially in the city center. Since April, it has eased up a bit, but still CBD Stockholm is struggling more than outside of the city center. So that's a little bit of the situation at the moment.
Thank you very much, Annika. So let's move on. And can you, Ramiro, can you tell what is happening on your market?
Yeah, sure. As you may know, as of today, the situation in terms of the pandemic is not the best in Spain. and that has definitely impacted consumption, employment, and of course real estate markets. So particularly for offices during Q3, we have seen a decrease of around 30% year on year in gross absorption. I mean, the space take-up, of course, has been impacted because of the uncertainty. Basically, corporates that have to make the decision to move to new offices are putting on hold that proper decision, and it's taking more time to close deals of new space or leasing deals. So at the same time, we have seen the rents going down just a little bit by only 5%, and our benchmark of prime rental values in offices also has decreased. This is something that we already forecasted in Q2 during the lockdown when we're thinking about the scenarios. We discounted that some difficulties to lease space were to be seen by Q3, and of course landlords are reacting with some discounts, if not generally in headline rents, maybe in effective rents, meaning that they are using TIs or tenant incentives to market their offices. So for example, added free rent periods to what has been the general practice in the market has been added, or some cash contributions to new tenants, which means the net effective rents are actually going down. So our benchmark has decreased in prime rents, and also we have seen in purely data-driven figures, which is the average rent, going down a little bit. And at the transaction level in the capital markets, we are seeing interest in prime property. So, of course, national funds and international investors are looking for good located offices or buildings with very good tenants or covenants and across the market. But we have to acknowledge that investment volumes have also decreased in Q3, and other assets are also picking up. So if in the past we were seeing offices like the leading assets in terms of share in investment volumes, we are that situation moving on to PRS, to logistics, and some alternative assets. But as I said, we have made a survey during the lockdown asking specialized and general investors in their interest in the Spanish market, and they remain quite optimistic. When the situation eases just a little bit, we believe they're going to keep on deploying capital in Spain, as they have a lot of what we call dry powder, which is there's a lot of liquidity in the market, and they're willing to invest in these type of markets in which when recovery comes, it comes fast. Actually, if you look at the forecast of GDP growth by Q2 or Q3 next year, we're talking about in excess of 10% growth, which is going to be good news.
Thank you very much. Thank you very much, Ramiro. Greg, from London, table is yours.
Yeah, thanks. So it's pretty similar to the two stories we just heard there, but perhaps the UK was hit a little harder earlier on. Our lockdown was fairly strict and came in right at the end of March. So our Q2 figures was really the first indication of how much activity would be hampered by that lockdown. So thinking about take up, it was around about 60% down rather than the 30% we heard just then. So for London, that was around 1 million square foot of take up for the quarter, and Q3 looks around the same level. In fact, maybe even slightly lower than that 1 million square foot mark. So Q2 and Q3 have been pretty similar for the office market. We had quite a good Q1, so as the year overall, kind of year to date, we're around 50% down, maybe a little bit more than that. And Q4 is probably going to have that same kind of level of activity. So that's kind of been the impact that we've seen so far under that lockdown. We've had our restrictions eased through the summer, and our cases came down quite a bit there. And actually, that's perhaps not made that much of a difference on the occupier market, but on the investor market, there have been more viewings, more properties being put on the market, and actually there's been quite a few large deals going through for offices. Logistics and the rest have also picked up as well. So it's just how well the UK market can keep that pipeline running towards the end of the year, knowing that we've also got a bit of a second wave going on in terms of cases coming through, more in the north of England than London this time around. It's kind of reversed by geography, but still we've got kind of cases rising and the restrictions starting to come through. So it's kind of trickier on the investment side to say where we'll land, whether we will get a bit of an uptick in activity towards the end of the year. If that pipeline does maintain itself, then we will see that pick up, particularly for London offices. But if the second wave and restrictions start to come through, we might see that slip into next year. But at least we've seen that when people can make the viewings and look through the buildings physically, that the appetite is there. We know that the capital is out there when these buildings come through. Like in the summer, London office market, big market, we only had 8 properties available on the market. So when buyers were looking at the market to see what was available, that's kind of all they were looking at a particular point in time, and that's increased quite a bit. So it's been really interesting to see how that's kind of played out. But we know that restrictions are coming in. We haven't got full lockdown like we had since March, and it is more local. It's city by city. Local authorities can make these changes, and so far nothing extra has come in for London, but most investors are just keeping their eye on exactly how that plays out.
Thank you very much, Greg. It's always very interesting to hear the updated news from local markets because, for example, yesterday in Moscow was actually a very strange and wonderful thing happened. Our rate of infection actually declined by about 30% just in one day. And no one knew exactly why that was happening, but someone suggested that that was because of Mr. Putin's birthday. So we are now looking forward what is going to happen today. So yesterday was a wonderful day in terms of infection. So I have one more question regarding the end of Q3 result. What do you see in absorption, net absorption? Do you already see significant net absorption on your markets? Because our colleagues from the United States in their global report, I will mention it later, but in global reports predict that next year in 2021, global office market will show net absorption of about minus 9 million square meters. So what do you see in your markets, Annika?
Oh yes, this is a very, very tricky question looking into the future. But what we see locally in Sweden at the moment is an increase of subletting. Many office tenants have during this spring maybe realized that they don't need all of that space for a while in the future now. So they are looking at decreasing their space a bit. And this has increased the availability on the market with almost 20%. But still, we don't see the vacancy rate going up between Q2 and Q3 yet. And we also, coming into this crisis, we had a very, very low vacancy rate on the office market, especially in Stockholm. And it's been very, very hard to add new space. And all of the new productions have also been pre-leased. So we do come into this crisis with quite a positive view. And then again, also we have for many tenants, the office is a competition advantage. attracting the right kind of talent. And it has been like that for a while in Stockholm, and we also see that ahead. So some of the really, really big employers, they are moving offices and they are expanding and they are interested in new space. But increasing space, I spoke to my colleagues today, and what we've mostly seen is outside of Stockholm, in other cities, government authorities are looking at expanding their office space generally there, but we haven't seen the same in Stockholm. But then again, the rent situation in Stockholm compared to all other cities in Sweden is quite high. So yes, it's in other parts where the expansion is happening.
Thank you very much, Annika. By the way, in Moscow, in 3 quarters, we lost about 430,000 square meters of net absorption, but we hope that we are through this shrinking process already. So, Ramiro, what is happening in your market?
Yeah. So during this quarter, we have not seen a lot of decrease in occupied space. So the way we estimate net absorption is taking into consideration like the dynamic of occupied space. So what you had today, you subtract what you had last quarter, and if the difference is negative, then you have negative net absorption, which is a reduction in your occupied space. You can have another approach, which is taking into account all the space take up and then measure all the released space. But we go for the other approach, and taking out the two figures between Q2 and Q3, we have seen just a slight decrease in occupied space that is not indicating a strong release of second-hand space to the market. So what's behind that is that corporates are not releasing this space because most probably they are inside the contract, because we have to remember that if we have a deep impact of the COVID-19, we are still in the short term. So it has not passed 1 year, and that normally is just a very small part of the contract existing in the market expire. So that is not going to impact in the short term the occupied space, meaning the net absorption. But our expectation is that by the end of the year, new contracts, most probably a good share of them are not going to be extended or are going to be renegotiated with a smaller space, whether it's in the same premises on another one, meaning that we are going to have a reduction in occupied space, meaning that we're going to have negative net absorption. So that's our expectation for the moment. Our vacancy rate should increase from the reference that we have today, 9%, to some 10%, 12%. And we have to keep in mind that the deliveries of new buildings that we have in the pipeline have kept on during the lockdown and throughout this second wave period, meaning that they're going to enter into the market and they're going to increase the supply. And vacancy rates going from that, as I said, 9% to 12% in Q1, Q2 of next year. So our contribution to those minus 9 million square meters most probably are going to be seen by the end of this year.
Thank you very much, Ramiro. Now, Greg, can you tell what is happening with absorption in your market? And also, I have one more question. Do you still feel the consequences of Brexit on office market, or everything is wiped out by the pandemic issues?
Yeah, sure. So in terms of net absorption, I think we'll follow that global pattern that was described in our report. So negative net absorption for 2021. I think that's fair that we're going to see that for London. So if I kind of described 2020 as the market where there's little activity, I think that will start to flow through the market to increase in available space into next year. So kind of what Annika was saying about the sublets coming through, we're seeing that a little bit. so far, but that's probably going to be something that will come back through into next year as those kind of leases start to roll over and less space and trying to remove a floor that you don't need and so on. So that's definitely going to be the pattern. In terms of vacancy rates, what's that going to do? Well, London's vacancy rate got down to around 4% at its low. It's been creeping up a little bit over the last year or two, perhaps Brexit related already. But in terms of peak, we're probably only going to get to around 8% in terms of a vacancy rate, because we've been at quite a low level. That's still quite a lot of available space coming through to get to that point. But so we're still looking at that peak being below the European average. That'll be up into 10% plus. For the US markets, particularly New York, if you're looking at for those comparisons, they'll be more like the high teens. APAC, they'll be up in the high teens as well. So we're kind of talking about a different level. But in terms of timing and the kind of that knock-on effect will be pretty much identical for London as it would be for other markets. So I think for the next year, it'd be interesting because, like you mentioned, Brexit there, we had our EU referendum in 2016. That took a lot of heat out of the occupier market and the investor market temporarily, at least. So occupiers were being far more cautious, rents started to level out, developers were being more cautious as well. We felt that we were late cycle anyway, regardless of that referendum coming through. So it feels like a bit of a long drawn out kind of slow down waiting for the next recovery. And of course, COVID took another big step down from that. So in terms of Brexit, it's kind of like this known entity now. I think most tenants have a no deal plan in place. We knew we weren't going to have passporting for our UK banks into the EU, but we still have a great uncertainty as to exactly what kind of equivalence agreements we can have in place in the various areas. So there's one area that's still a bit like what's going to pan out from January onwards. But at least for EU banks in the UK, they've kind of got a guaranteed equivalence. Our authority, the FCA, have some temporary powers to effectively extend their transition period to March 2022. So it's kind of business as usual for a European bank operating within the UK on that side of the street, but some continued uncertainty for UK into the EU on that side. So it will play a little bit of effect. But as you're saying, a lot of the Brexit type of analysis was, well, if GDP growth for the UK is kind of 1.5%, how much of that are we going to lose in the short term? How much of the long-term trend growth do we lose off that benchmark? And obviously, we've just lost 25% of GDP because of our lockdown, and we're on the way back up. So I'm not negating or ignoring the impact of Brexit, but it's to that kind of scale. And when we think about GDP growth, like Ramiro just said just then, like just the mathematics of it, we might have +5, +10% GDP growth next year just by the index just coming back up off those restrictions. So unpicking the impact of Brexit versus COVID is going to be very difficult to do next year anyway.
Thank you very much, Greg. Ramiro is raising hand. Ramiro, you want to add something?
Yes. I wanted to give a little bit more color on the impact of unemployment to this negative net absorption, and comment also to what Annika just said about subleases. So I believe that unemployment rates are going to remain subdued, although we are having this decrease in activity. The instrument that or government, and I understand governments across Europe are implementing from the regulatory side, is the furloughs. So furloughs are really helping corporates, especially from the retail sector, or in the case of Spain, which is critical, the hospitality sector, not to let go or lay off a lot of employees, meaning that redundancies and unemployment rates are going to remain low, and Spain is actually helping those companies to keep on paying their salaries to those employees on furlough. So that is going to help some corporates not to release office space short term, which is going to help the absorption to keep a little bit less negative. And if if corporates are expecting that the impact of this pandemic is not going to be until we reach the midterm or the long term, they're going to use the subleases. So that means that companies are thinking that their contract is still 2 or 3 years or 4 years to expire, whilst we have this situation in the short term next year or next 2 years. Let's release the space, but let's not terminate the contract, which is quite interesting. So those increases in vacancy rates from the side of subleases are going to be a different animal, in the sense that the corporate that owns the main contract is still having an expectation to return, and that is giving you a message. The sheer existence of subleases in the market is telling you that expectations of companies, at least for the moment, is still to come back in 1 year or 2 years to the space use levels that they were having pre-COVID. So it's quite interesting.
Thank you very much, Ramiro. And now we're moving to the second part of our discussion is the report, the Global Office Impact Study and Recovery Timing Report. Dear colleagues, you can find this report on our website. Take some time, go through it, because it doesn't have all the answers, but it has lots of questions, and it's very good starting point for thinking what is going to happen next year with office market, with investments, and other important things for real estate. So let's talk a little bit about the major trends, opportunities, and disruptions that you see on your markets. Annika, traditionally we'll start with you.
There, unmute. Yes, this is a very interesting question. I mean, we have seen quite a lot of disruptions already, especially for the retail sector, with the increased online shopping, which has had a really positive impact on the logistics segment. But in Sweden, we're not really used to see the large vacancies that we see in the retail sector at the moment. And hopefully, I hope that we can find alternative use for that space. I was talking to our colleague Andrew Phipps before the summer, and maybe you could create office space in these ones. And in some locations in Sweden where we have very low vacancies, maybe that could be something. But one of the big disruptancies that we see at the moment is, of course, sustainability. We talked about it already in Outlook 2020, that we see a potential risk that increased regulations from EU might have a very big impact on how investors see different type of investments, and also how the financial market sees the real estate market. So that might be one. Another positive trend that we are also already seeing is the online to offline trend, where companies who have been a success online can be both in terms of selling goods but also selling services. We see in Sweden a very big positive trend within the healthcare sector, with digital doctors and so forth, and they need new office space, so that might be something positive coming along. And the last one I want to talk about is local food production, or city gardening. This is a trend that we see a little bit It hasn't fully bloomed in Sweden yet, but many of the grocery stores have now, they grow some of their vegetables in their stores, and that might be something that we need to, when we are looking at how we build our cities and how they work in a circular way, that might have an impact on the real estate market, but still small at the moment.
It's interesting. I mean,
Thank you very much, Annika. It's really interesting observation. Greg, can you talk about your observations and what opportunities do you see at the market right now, and what factors you think that can be major disruptors?
Yeah, I think for us, it's similar trends. It's all kind of work from home based for the office market, and just trying to think about how that might change the location preference for some businesses and for where people work. So for London, it is quite heavily focused on central London. It's maybe a little different to perhaps Paris or some of the other big cities. So what we're thinking about as well, if people are going to take their commute into central London less often, but they're still working around outer London or the outer areas, does that mean that they'd want to work near home, or they still work from home? And they're quite big numbers. You know, in some of these outer London areas, there'd be people in one particular borough, it's kind of 20, 30,000 people that on any given day might be staying at home rather than going into the office. So that's 20, 30,000 people that might want to go to their local high street to work. So should co-working be more around providing some more local work options in residential areas rather than in central London for travelling staff? So there's lots of big corporate memberships sold to some of the big providers, assuming that somebody is going to be going from New York to London or whatever it might be. Could it actually be more co-working for some of the people that are more local, just not going to commute there? And the other thing is, well, for some of the big locations like London, could there be some more satellite offices, something a bit more formal on offer by some of these companies? So not just a drop-in centre or a membership available to you that you can go to your local kind of working environment, business park or high street. Could there actually be a smaller local office? And these kind of options are starting to be discussed. I think the former will be quite big, just naturally more and more people working from home, perhaps wanting on offer the ability to go into some local office space for them, like a membership based, your company's paid on your behalf, you drop in whenever you want. But also the natural impact that people will want to buy lunch and shop and all the rest. That could be a bit of an improvement for the UK high streets that have been really suffering for quite some time as well, and less of an extent of, rather than having the big headquarters, maybe a smaller headquarters and more satellite offices, that's only going to be applicable to some big companies that might want to take that as a short-term experiment. I think that's going to be less of a disruptor and less of an impact. But for the office market, at least, that's where most of the discussion is going to be. Can you entice people out of their home as they work? And are there going to be some big decisions by some of the big occupiers making a different kind of strategy for their overall office portfolio?
Thank you very much. Greg. Ramiro, what you think?
In terms of the trends that are mentioned in our global impact study, I think it's worth to reflect upon work from home, because recently I saw a presentation, or I don't know if it was in the news, that in Q2 we saw the largest increase in productivity the humankind has ever seen, and because we all of us, we were in lockdown, we were at home, and we didn't have nothing to do instead of working or taking care of our family or at home. But anyways, work was always present, and we were all worried about what was going on with our jobs, with our companies. So we were kind of helping to the limit to keep on and be there. So it was great, but I believe it's going to be a trend that is short-lived, because my view on work from home, permanent work from home, is that some dynamics are going to be lost, meaning that interaction basically is what comes quickly to your mind, is not anymore present. And it has been, let's say, studied, and I would dare to say proved, that too much time at home is going to increase your feeling or your sense of isolation, and even for some people could be ending in depression. So we have to keep that in mind. So Greg, I don't know if you want to add up something there.
No, yeah, exactly. I completely agree with that, and I think what gets forgotten a little bit around co-working and the serviced office space was there. Take WeWork and other examples. I know that has been going for 50 years, but the more modern kind of version, the whole point was to entice freelancers and small companies who do work from home into the office space, be part of the community. That was the initial growth. Yeah, they sold hundreds of memberships to the big corporates towards the end, and they started doing fit outs for entire floors of space. But that growth, that kind of disruptor, that initial phase was they could quite easily go to all these freelancers and say, we can offer you a desk per month, and that's going to be far better than working from home. And everyone said, yeah, why has the traditional landlords not been offering this? Why has it been the likes of WeWork to make that step? So that's not changed post-vaccine and all the rest, of course. But on the other side of this, the idea that people would rather try and be part of a community, part of culture, is far more attractive, certainly when you're part of a big business, but even if you're an individual and a freelancer, you want to be part of that. I don't think that's changed too much, but I completely agree with the productivity points as well. We will never be as productive under lockdown, under that kind of pressure. Again, that's going to change. And when we're all working through, in our world at least, existing projects, we'll have to go back into the office to work out, right, what's 2021 going to look like? What's the next project? We need to collaborate and work with new teams. So it's not just working through our existing work, which is what we've been doing so far.
Yeah, that's it, definitely. So if you have that in mind, then you can say, all right. So if it's the high productivity effects are going to fade away, what's going to come next? And that's a question, and that's, I believe, the answer for your question in terms of what's going to be the big disruptor next year. It's help our clients to find what I call the occupancy mix. So let's just help corporates to see what's the current mix of work from home, permanent office-based employees, and what they call in the report the agile work. Agile work is some part of your day at home and going to the office, then come back, or a few days in the office, and find out that equilibrium. That's going to be the big disruptor, because let's say for some companies, the taboo just disappeared. I just cannot work home office because I just can't control my employees, and that has been proved wrong. And the big social experiment has already been done. So now we're going to help clients and corporates and even landlords to find out what's the correct occupancy mix for the talent they are putting in their offices. And that means that we are going to have to study how productivity is going to be maintained with work from home. By this, I mean future talent needs to be nurtured and needs to be managed, and they need to be mentored. And maybe with a occupancy mix to lean to home office, it's going to be more difficult to nurture that talent in the future, which is going to be the leadership of the companies. So it's a matter of short-term productivity in terms of keeping what you're doing now, and long-term productivity, which is increase the talent of your work base. It's a talent question, and I believe that the occupancy mix is going to answer correctly how we are going to increase the productivity in the long term by nurturing, as I said, the future leadership of, and that I believe should happen, most of it, in the offices.
Exactly. Thank you very much. By the way, I think we are taking out of equation one important thing. Today, I was a moderator on conference for designers, architects, investors, landlords, and tenants for offices. It was probably the last offline event in Moscow for probably next couple of months. But it was interesting. It was kind of the event itself was sort of a test case of social distancing and safe space. But what's important? Architects were talking about the price of desk, the price of square meter, the fit out cost, and the average fit out cost in Moscow would be roughly about maybe from 5,000 to 10,000 euros per workplace. But when we think about home office, we actually kind of take it for granted. We're not thinking about the let's say the fitting out the workplace at home. For example, myself, I'm doing a lot of experimenting, and I started, for example, experimenting with smart home about a couple of years ago, and I know by myself what it is and what are the issues and problems with that. And now I'm experimenting with a workplace, with a decent workplace, and I try different approaches, and now I'm coming to the understanding that in order to create the workspace, the quality workspace, to work efficiently, with the same efficiency as in the office, it will require probably about 7,000 euros just for the equipment itself, because it comes, for example, with lighting. In office, you have the proper lighting. At home, you usually you use it in the evenings, but when you sit the whole day in the room with artificial lighting, just regular home artificial lighting, your eyes are getting tired much easier, and it's everywhere. So what do you think, will we see situations when employers will be forced to organize and to pay for home desks, for home workplaces? What do you think, Annika?
Yeah, I mean, it's been quite an interesting spring. We have had a lot of our big employers saying that their employees should stay at home up until New Year's or up until next summer. But that after the summer now, I think we see different signals, and we are rather more in projects where how we can connect the
Annika, you're on mute.
Sorry about that, I have company.
Okay.
No, but now it's rather in the discussion on how.
Oh, maybe Greg, you can pick up. Maybe Greg, you can pick up this topic. Mm-hmm.
I'll go next, and then we can come back to Annika. Yeah, I think employers will have to allocate some costs to helping people fit out their home office. I think that's natural. I think especially if there's trying to cut back on the office space, or even saying to people you don't have an allocated desk on every weekday. I think that's going to be something that will just say, look, we're making a saving here, but we also need to put some of those savings back into some home office equipment to basic levels. And I think that's fine as long as people have that space. I think we always come back to thinking about younger people renting, they don't have that kind of space. You know, if more than one person is working from that flat at any one time, one's in the bedroom, one's in the kitchen, you know, it's still not going to be great regardless of the level of equipment. So I think there needs to be full surveys around what is people's home office environment before we think about the equipment and the lighting and monitors and all the rest, and then allocate some costs to making those improvements. And it will vary from company to company. Some might have huge teams of kind of grad level data admin type of people. That could be 50, 100 people in that kind of difficult situation where they would want to work from the office regardless. whereas other people might be more senior niche kind of firm, 10, 20 people, where they'll quite happily work from home just because they have that kind of space available. So it will have to be case by case, but they certainly should allocate some funds to help support people with their equipment.
Thank you very much. Annika, back to you.
Yes, thank you. Especially that happened right now. When you get disturbed in meetings. I mean, that's what's not supposed to happen. And that's one of the reasons that many people want to come into the office, because you have situations at home, or maybe you live too small that you cannot do your job properly. But at the moment in Sweden, we see different trends. One of them, from the residential perspective, is that people are buying, if they can afford it, larger space where they live to be able to work from home in a good way. But we see this, or the developers for residential space see this as a kind of a short-term trend. In the future, the space will decrease as it has trend-wise before. But in Sweden, I haven't heard of any big companies supporting with equipment at home on a money-wise, but definitely equipment-wise, that they buy in proper screens and so forth.
Thank you very much, Ramiro. You're on mute. Sorry.
Yes. No. Yes. No. Just to comment quick on it. There's two main points. Regulation. I believe all governments across Europe are taking hands on that issue and trying to regulate home office, so we will see action from the regulation point of view. What's going to happen in terms of you are considered permanently from home, then the company in which you work will have to contribute with something if that's the case. If there's no regulation, I believe it is going to be kind of a bargaining process in which some employees that actually need that are going to ask for it, and the companies, some of them are going to give them the equipment or the money, some of the others not, and then we're going to see some, as I said, bargaining process or going back and forth until we get to an agreement. So there's going to be a reaction on the regulation, and there's going to be, as I said, a negotiation process. In my case, for example, I have the screen I used to have in my desk. I have it now at home, and the same is with the chair. so it's a great chair, I have to say, that I have at home, and it has been provided kindly by the company. So at least they are sharing that, and that's the way of contribution. So it's I have to say quickly that actually they have helped here, but yes, some improvements need to be done at home, and the special cases are, as Greg said, the young people. They don't have the space, they don't have the fit out, so that's going to be quite important and quite critical to have these people if they decide to work from home.
Thank you very much. Thank you very much, dear colleagues. Please, for your attention, please check out our other IQ interviews. You may find on YouTube IQ interview with Andrew Phipps, our head of EMEA research. And today with us was actually the brain power of EMEA was Greg Mansell, partner head of UK Research and Insights. Greg. Was Dr. Ramiro Rodriguez, Associate Director, Head of Research and Insights, Spain. Annika Edström, Head of What's Next Research in Sweden. And me, myself, Denis Sokolov from Moscow. Thank you very much. Bye.
Thank you.
Thank you, Denis.